Hello guys, I welcome you to our channel Global Tech on Tube with a series of clean and true verbatim videos on standards set by accounting standards bodies. So we're not going to discuss two standards, that would be IAS 17 and IAS 18, that is of leases and revenue respectively. So without wasting any further time, just going to talk about the standards. Hope you're going to like our video. Thank you very much. IAS 17 leases prescribes the accounting policies and it disclosures applicable to leases, both for lessees and lessors. Leases are required to be classified as either finance leases and operating leases. IAS 17 was reissued in December 2003 and applies to annual periods beginning on and after 1 January 2005. The objective of IAS 17 is to prescribe for lessees and lessors the appropriate accounting policies and disclosures to apply in relation to finance and operating leases. Scope is IAS 17 applies to all leases other than the lease agreement for minerals, oil, natural gas, and similar regenerative resources, and licensing agreements for films, videos, plays, manuscripts, patents, copyrights, and similar items. However, IAS 17 does not apply as a basis of measurement for the following leased assets. These are property held by lessees that is accounted for as an investment property for which the lessee uses the fair value model set out in IAS 40. An investment property provided by lessors under operating leases, biological assets held by lessees under finance leases, biological assets provided by lessors under operating leases, IAS 41. Classification of leases. A lease is classified as a finance lease if it transfers substantially all the risks and rewards incident to ownership. All other leases are classified as operating leases. Classification is made at the inception of the lease, and whether a lease is a finance lease or an operating lease depends upon the substance of the transaction rather than the form. Situations that would normally lead to a lease being classified as a finance lease include the following. The lease transfers ownership of the asset to the lessee by the end of the lease term. The lessee has an option to purchase the asset at a price which is expected to be sufficiently lower than fair value at the date the option becomes exercisable. That at the inception of the lease, it is reasonably certain that the option will be exercised. And other situations that might also lead to classification as a finance lease are if the lessee is entitled to cancel the lease. The lessor's losses associated with the cancellation are borne by the lessee. Gains or losses from fluctuations in the fair value of the residual fall to the lessee, for example, by means of a rebate of lease payments. The lessee has the ability to continue to lease for a secondary period at a rent that is substantially lower than market rent. And accounting by lessees. The following principles, should be applied in the financial statements of lessees. The one principle is that at the commencement of the lease term, finance leases should be recorded as an asset and an liability at the lower of the fair value of the asset and the present value of the minimum lease payments, discounted at the interest rate implicit in the lease, if practicable, or else at the entity's incremental borrowing rate. Finance lease payments should be apportioned between the finance charge and the reduction of the outstanding liability. The finance charge to be allocated so as to produce a constant periodic rate of interest on the remaining balance of the liability. The depreciation policy for assets held under finance leases should be consistent with that for owned assets. If there is no reasonable certainty that the lessee will obtain ownership at the end of the lease, the asset should be depreciated over the shorter of the lease term or the life of the asset. For operating leases, the lease payments should be recognized as an expense in the income statement over the lease term on a straight line basis, unless another systematic basis is more representative of the time pattern of the user's benefit. Incentives for the agreement of a new or renewed operating lease should be recognized by the lessee as a reduction of the rental expense over the lease term, irrespective of the incentive's nature or form or the timing of payments. And accounting principles to be recognized by lessors applied in the financial statements of lessors are: at the commencement of the lease term, the lessor should record a finance lease in the balance sheet as a receivable at an amount equal to the net investment in the lease. The lessor should recognize finance income based on a pattern reflecting a constant periodic rate of return on the lessor's net investment outstanding in respect of the finance lease. And assets held for operating leases should be presented in the balance sheet of the lessor according to the nature of the asset. Lease income should be recognized over the lease term on a straight line basis, unless another systematic basis is more representative of the time pattern in which use benefit is derived from the lease asset is diminished. And incentives for the agreement of a new or renewed operating lease should be recognized by the lessor as a reduction of the rental income over the lease term, irrespective of the incentive's nature or form or the timing of payments. Manufacturers or dealer lessors should include selling profit or loss in the same period as they would for an outright sale. If artificially low rates of interest are charged, selling profit should be restricted to which would apply if a commercial rate of interest were charged. And just at the end, we're going to talk about the disclosure in respect of lessees and lessors, both for finance lease and also for the operating lease. Talking about, first of all, the disclosure in finance lease in term of a lessees. In term of a lessee, that would be, first of all, would be carrying amount of asset, reconciliation between total minimum lease payments and their present value, amount of minimum lease payments at balance sheet date and the present value thereof for the next year, years 2 through 5 combined, beyond 5 years, and contingent rent recognized as an expense, total future minimum sublease income under non-cancelable subleases, and a general description of significant leasing arrangements should be disclosed in lessees if it's a finance lease. And a disclosure in lessees if it's an operating lease, that would be amount of minimum lease payments at balance sheet date under non-cancelable operating leases for the next year, years 2 through 5 combined, beyond 5 years. Total future minimum sublease income under non-cancelable subleases, lease and sublease payments recognized an income for the period, contingent rent recognized an expense, general description of significant leasing arrangements. And if we're going to talk about the disclosure in lessors, if it's a finance lease, that would be reconciliation between gross investment in the lease and the present value of minimum lease payments, gross investment and present value of minimum lease payments receivable for the next year, years 2 through 5 combined, beyond 5 years, unearned finance income, unguaranteed residual values, a cumulative allowance for uncollectible lease payments receivable, and contingent rent recognized in income. And also disclosure in lessor when it's an operating lease, amounts of minimum lease payments at balance sheet date under non-cancelable operating leases in the aggregate and for the next year, years 2 through 5 combined, beyond 5 years. Contingent rent recognized as an income should be disclosed, as well as the general description of significant leasing arrangements. And that's all for IAS 17 leases. If you have any question, you can talk about in the comment section below. Thank you very much. Mentioned early on in the intro, now I'm going to discuss IAS 18 revenue. Thank you very much and keep watching. IAS 18 revenue outlines the accounting requirements for when to recognize revenue from the sale of goods, rendering of services, and of interest, royalties, and dividends. Revenue is measured at the fair value of the concentration received or receivable and recognized when prescribed conditions are met, which depend on the nature of the revenue. IAS 18 was reissued in December 1993 and is operative for periods beginning on and after January 1995. Talking about the objective of IAS 18 is to prescribe the accounting treatment for revenue arising from certain types of transactions and events, and the key definitions involves revenue, measurement of revenue, and revenue is actually the gross inflow of economic benefits, cash, receivables, other assets arising from the ordinary operating activities of an entity, such as sales of goods, sale of services, interest, royalties, and dividends. How you can measure the revenue? Revenue should be measured at the fair value of the concentration received or receivable, IAS 18.9. An exchange for goods or services of a similar nature and value is not regarded as a transaction that generates revenue. However, exchanges for dissimilar items are regarded as generating revenue. Recognition of revenue. Recognition as defined in the IASB framework means incorporating an item that meets the definition of revenue, obviously we have mentioned above, in the income statement when it meets the following criteria. It is probable that any future economic benefit associated with the item of revenue will flow to the entity and the amount of revenue can be measured with reliability. IAS 18 provides guidance for recognizing the following specific categories of revenue, that is includes sale of goods, and revenue arising from the sale of goods should be recognized when all of the following criteria have been satisfied. The seller has transferred to the buyer the significant risk and rewards of ownership. The seller retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. The amount of revenue can be measured reliably. It is probable that the economic benefits associated with the transaction will flow to the seller, and the costs incurred or to be incurred in respect of the transaction can be measured reliably. And rendering of services. For revenue arising from the rendering of services, provided that all the following criteria are met, revenue should be recognized by reference to the stage of completion of the transaction at the balance sheet date. That is called the percentage of completion method. And the amount of revenue can be measured reliably. That's the first point. And second is, it is probable that the economic benefits will flow to the seller. Third, the stage of completion at the balance sheet date can be measured reliably, and the costs incurred or to be incurred in respect of the transaction can be measured reliably. When the above criteria are not met, revenue arising from the rendering of services should be recognized only to the extent of expenses recognized that are recoverable. That is called a cost recovery approach, IAS 18.26. And when talking about the disclosure contains certain items which include the accounting policies for recognizing revenue, amount of each of the following types of revenue, that is sale of goods, rendering of services, interest, royalties, dividends. Within each of the above category, the amount of revenue from exchanges of goods or services. And implementation guidance is also been mentioned in the same standard. I'll going to end the discussion on the IAS 18. I'll hope that you keep liking the videos. Leave a subscribe, like, or a comment. That would be, if you're liking the videos, that would be highly appreciated. I thank you again. We'll come up with the series of international accounting standards yet again, with the different items, with the different standards, and with the different accounting international standards to be discussed in our series of